Hello guys, and glad to have you on board again today. I wanted to make an English update because I've been recently very active for the French community and far less for the English portion of it. So in that perspective, I thought it was worth it to make kind of finally a global review of what I think the market is up to now. What are the risks and dangers lying ahead? Are they really rational? Are they just fake outs? Like fake bear markets narrative and stuff like that. We're going to try covering all of this because I think this is the major topic, actually pulling the market into speculative behaviors right now. So let's talk about it. Let's look at the charts. Let's see what could be the validation or invalidations of these perspectives, all the things that I am paying a lot of attention to right now. So these are all the things that I've been covering almost real time over the latest couple of weeks or the last month, as it's been a terrible month for crypto. Not just for crypto, it's been for the stock market as well. So I'd like to give you the glimpse of what I can pull out of the market actions that happened recently, and therefore not a forecast definitely, because, well, I've been taken by surprise by these so-called bear markets. On the crypto, not covered at all in the portfolio, so huge drawdown. I'm 50% off on the drawdown of the all-time highs of the portfolio. So once again, no trading actions performed, so drawdowns is just drawdown. Okay, but I wanted to go first of all public with this, so I'm suffering this drawdown like many of us in the crypto sector as well. Even though I am a professional trader and therefore covering my portfolio on dangerous times is also normally supposed to be my job, I didn't see this one coming like at all. So what we're talking about is basically when I look at the crypto 30, which is the top 30 crypto, which once again you should have exposure to, not seeking for definitely crazy alpha like it was in the 2021 era. Don't even think that this is what's coming next. So it's going to be, best case scenario, a recovery factor that would invalidate the bearish narrative that we're currently into. Okay, it has been as well for the stock markets, but once again I would say it, I don't think the stock market is going bearish at all. I think the only thing we have is a necessary pullback that we were definitely waiting for. I've been covering my stock portfolio, just didn't thought it was worth it on the crypto, and it was definitely a big mistake. So let's talk about it, charts first. But before we study prices themselves, I would like to talk about something. I think that what we've experienced is a switch into the speculative cycle. So this is another video that I've made for the French guys that I couldn't find the appropriate amount of time to do it for the English guys. So I'll try to sum up the core essentials that you might want to learn about that. So there are multiple cycles, all overlapping one each other and never being in sync. So there is the macro cycle, which is generally a 50+ year cycle, which generally turns to a narrative at center stage, and there are multiple sub-cycle developments of this. So to sum up the essentials of it, I think the best thing that explains this is one video that has been viewed millions of times. I think this is from Ray Dalio, and you would definitely figure out this one on your own. So I'll let you guys Google this one. This is kind of the macro currency cycle that plots around generations, and this is a 50+ year cycle. This one has been lasting for a long time, and this is basically the cycle in which the dollar has been the reserve currency, Bretton Woods Accords, and all of these things. You know all about it probably, so I wouldn't go down the details of it. I suggest you look at the Ray Dalio's video. It's definitely very well handled and crafted, so way better than what I could do in here with my arrows plotting. Okay, so we might be nearing the end of the dollar cycle because, well, just like every cycle, it has to put an end to it. But most importantly, things never repeat endlessly. I think we're also at the end in which currencies, national currencies, have been putting in a worldwide step forward by being the reserve currency. I think we're on the verge for this to break, because now that everyone knows about this cycle, when it's also when cycles break, because that would allow us to predict the future. And I think this is how, now that we clearly see the pattern repeating multiple times over time, I think it's an appropriate time to change the mood. By that, I still think that what's next to come for the next macro cycle is to finally, for the first time in humans' history, we're going to step off this cycle of one country imposing its currency as a reserve for the rest of the world, which means the rest of the world indebts itself into this. The reason leading me to believe this is that, first of all, like I said, when there's a cycle, that means we could predict the future. So right now, the motive would be dollar steps down as a reserve currency after profiting from this for decades. And the suggestion might be that the leading new currency would be the one that has the upside momentum. And in that perspective, that would be China. So the logic would be US dollar steps down and Chinese yuan turns out to be the next leading currency for the next macro cycle that would last 50 to 70 years. So in that perspective, I think that this is very less likely going to happen because we're probably going to get a bipolar world rather than a China first world and a declining US world. I don't believe that narrative at all. I mean, US is definitely a center of innovation, and therefore innovation can fight its dominance for a long time. China has been stepping up. Definitely they have upside momentum, but I don't think we're on the verge for a collapse of an old system to create another one that this Ray Dalio cycle is supposed to tell us. So I think in that perspective, cryptocurrencies and specifically Bitcoin has been the emerging kind of outside option for these to break out of this cycle. That doesn't mean Bitcoin will be there forever. I think it will create its own cycle. We'll see if it can last longer than the 50 to 70 years cycle. But still, that is my current motive, and it's been since I've seen the crypto bubble in 2018. It's definitely have had all the pre-requirements for me to be a revolution, so something big enough in terms of breakthrough to actually be able to break that centuries-long cycle that Redalio explains. So this has always been my background narrative for this, that Bitcoin will eventually, due to its breakthrough in terms of changing humanly driven printed currencies, that the world is imposing over the rest of the world by force, which is basically, well, post-war, US were the winners and they were in a strength position to impose their currency to the rest of the world, which had created out of the macro world currency cycle has created the economic cycle. Okay, so macro is how value is distributed. Economical cycles are the ones that play over time. So the latest cycle we're into, which is a shorter cycle, this one tends to be from 10 years to 20 years or something. This is not as clearly defined as being regular. It's really varying a lot in times. So first element is this. I think the macro 50, 70-year cycle is about to break because we're going to stop having a national currency imposed to the rest of the world so that this country who is having the reserve currency can indebt a lot and export that debt to the rest of the world, which basically give it a hedge over the rest of the world, which will create tremendous growth and then over-indebting and creating debt collapse, money printing, the things that Redalio explains a lot. So this thing is that as we will lose control to create currency if we switch to a Bitcoin-like world, as there is predictable inflation and that it will reduce over time, this would definitely and drastically change the world as a background kind of thing. This cycle would break because for at least a limited amount of time, and surprisingly, Bitcoin is going to stop inflating in 50 years from now. So interesting things to think about, but still, this is 50 years from now, and we haven't even yet switched to a dollar reserve kind of world. But if we do, then that will change something. That means that for the first time in history, no country will have leadership over the world, which would correlate to the actual current motive that I have in my mind, coming from another book that I really liked a lot and I would recommend you reading, which is the CIA's projections over the world leadership. And they basically have multiple models, 5 of them in total. The most favorable one, in my personal opinion, of course, this is just a personal choice, you might disagree, I recommend you to read the book to find out the 4 other ones, is kind of a balanced world in which the supposedly falling dollar area of the world isn't going to fall as people think, just like the China rest of the world isn't going to take over like people would suggest out of the radial cycle. But we kind of have to externalize that pattern. And as no one will have reserve currency over the rest of the world, and if we switch to Bitcoin, then we're going to have a dual kind of pole world in which economical activity definitely is a lot more intense in the US and in China, but they will not have the strength to impose debt over the rest of the world, as there will be no reserve currency. They won't be able to print endlessly and more than the other currencies, because otherwise they will devalue against the reference currency that would definitely, in my personal opinion, turn out to be Bitcoin as a safe reserve asset with limited and programmable inflation. So I think this will become a big game, and I've always thought it that way. I mean, Bitcoin is not a currency to trade on a day-to-day basis. This is not the people's money. This is the leaders of that world kind of money. This is the gold of old ages before we turned out Bretton Woods and stuff like that. Okay, so that's what I think about Bitcoin. So this is why I think this macro cycle is going to break, but it's still, at the current time, this is definitely, anyway, that's the cycle of a lifetime. So we'll see if there is definitely going to be a generational change in this macro cycle. But anyway, we're nearing the end of the dollar's dominance. That's definitely something that we may account anyway. So dollar may be falling faster or slower. This is hard to tell. Like I said, the slower pace is definitely the one, in my personal opinion, that will favor the breakout of this cycle. And in order to break, we need to change the narrative. We need to change the cycle. And that's what I think, that the only way we can break out of this dominant currency cycle is to externalize that currency to something that doesn't belong to any state. Something that is not imposed by force, but something that is imposed by choices, by adoption. So this is why I've always felt like Bitcoin was a revolution, and as it gets broader and broaderly understood, people will natively want to change. I mean, we want out of this world that seems to be predictable enough that we know that US will fall and China will rise. So anytime there is a cycle and people know about it, we always want to break out of it. So that's my narrative for the broad macro cycle. Then in terms of economic cycle, we can see the pattern in here as well, but this pattern is way more complex to break, and there's no point breaking it. It's just that we change the narrative, of course, at each and every cycle. So this cycle, I think the one we're currently into, has been lasting for quite some time now, because it is basically, the first cycle we had was post-war, in which we basically built this one out of the Industrial Revolution and improving the production things. So we've discovered new energy sources, mostly petroleum and derivative oils. So this has definitely been the major driver of this post-war economic cycle, bringing industries to create wealth and goods and services and all of the and goods principally. And then came the next cycle, which is the debt cycle, in which we've discovered monetary creation processes, the magic of printing money, and it's basically been used massively by the US, debunking the currencies while still exporting the debt. So you don't devalue the currency relative to others. Basically, the entire world goes in debt. So when the entire fiat system loses value because we print money all across the board, US printing more than others now, but as they export the debt, they do not yet suffer the consequences. But we've seen that changing. This is yet another indication that the cycle is nearing the changing pace. So I think lots of changes coming over the next decade, because multiple cycles tend to reach their switching area. Though the macro cycle might be on the verge to terminate, or at least we have pressure terminating it more than starting that being at the beginning of a new one. So it's really more of that. We're at the end of a cycle and we don't yet know what the nature of the next cycle is going to be. My personal belief is that we'll terminate these national currency cycle to turn to an external currency dominance. Okay, so the macro cycle, we've seen the industrial thing, and then the debt cycle, which is the one we were into and possibly still are into, but I don't think that's necessarily the thing. I think this debt cycle is nearing its end as well, in which we basically have fueled growth with debt first. Then we had to sustain that debt as it had issues, and we clearly have seen those issues in 2008. And I think we're currently into the decline cycle of the debt system, which is basically we start to see the negative consequences of over-indebted countries and stuff like that. Now we have to print baby print in order to make it sustainable enough. And of course, this is just like patching the good old problem. So we're in the decline of that debt cycle as well. So This is where we see a lot of tensions, a lot of uncertainty and stuff like that. Very interesting ages ahead, of course, because that's when things are changing, that opportunities lie ahead. So this is what I think, okay? Multiple cycles, macro cycle and economic cycle nearing the changing point, or at least it is an appropriate time to start thinking about the next cycle. And I've always had a kind of a memorandum on my head about these things. That's basically when we terminate a cycle, there's always a bubble popping at the end that gives us kind of a hint of what the next cycle is going to be all about. So definitely, I'm not looking at the excess of the current cycle. So all the depth excess and stuff like that is not something I care about, okay? What I'm looking at is by the end, or as we reach out the tension points and failure points of the debt cycle, what do we do with that debt to prepare for the next thing? And this is where, as well, cryptocurrencies have emerged, not just Bitcoin as a store of value, which will disrupt the major, massive macro cycle, but we've seen other alternate cryptocurrencies who has been bringing native technology on how to move money around in a much easier and trustless manner by basically destroying all the middlemen that were actually building up that debt today. Remember that debt isn't created by the central banks. People believe it, but that's not how it works. Central banks does not create money. The banking system does by the credit system. So the credit system is what creates money today. And I think that the challenging thing we have against bank is not Bitcoin. Bitcoin is challenging the world order, okay? And the reserve currency status. So I think Bitcoin is one side of the equation that is kind of what I think the best possible option, at least the one I choose, to terminate the macro cycle. So I think Bitcoin has a much longer perspective than other currencies that are playing on a shorter cycle. Okay, so I think Bitcoin is the alternative system for the next macro cycle. So Bitcoin may take a longer term to actually settle itself, because we're on longer term perspectives. On the second hand, like I said, the economic cycle based on depth for the last cycle has been bringing a hell of a lot of other bubbles, like Ethereum on 2018 as well, I think is playing on a totally different field. The Ethereum-like or alternate layer one's competition or whatever, they all have one single purpose, is to facilitate money moving around and value being placed in different part of where there is demand. So this is basically another economic system in which banks are no longer necessary. We do not need financial intermediaries to create debt and spread the money all across the economy. I think that what ETH has created is everyone being its own banker. You will have units of account, Ethereum or whatever else currency will end up being used. Ethereum might just be a proof of concept in the end, future will tell. But that's the technology that came with it that is very interesting. That's the technology that will replace the banking system. It definitely immediately sounded rational enough to me to figure out that this wasn't just a tulip bubble. This was definitely a technological breakthrough on how to efficiently, without middlemen and without any third-party trusts, would be able to move money around and to program that money and to create subunits of accounts. So this is basically like Ethereum has its own, has created its own system. Of course, that doesn't mean Ethereum will be there forever. It just means that whatever has been created with that technology is a breakthrough. And I think it's a breakthrough that will terminate the debt cycle when this one will fall, while already creating the systems for the next one to come. Like it always been the case, okay? We create depth first, there is a bit of a problem of it, and then comes the depth cycle, okay? So this is really all about it. If you've seen and if you study the end of the Industrial Revolution era, this is where we discovered how to money print. Not to mention that, for example, that's how the Germans ended up being in creating the Second World War by creating bonds out of nothing, and this is how they've managed to actually rebuild their army and stuff like that out of just debts, out of IOU stuff, which allowed them to break through the restrictions that they had out of World War I. So in that perspective, this is really what this was all about. We've created magical system back then that were the preceding of what the rest of the world would do afterwards, creating IOU paper things That would basically allow to create endless amounts of wealth out of absolutely nothing. But it's great because it's created growth, and that's one thing. So we had that cycle, but now we see the negative effects of it, and we look for the glimpse and excesses that the market may create to let us know what are the probabilities for the next cycle to come. And I definitely think that by the latest few years, the only thing that's rationally enough has been breaking through, I think, is this technology to move money around without third party, being your own bank thing. And Ethereum has been the representative of it. Future will tell, of course, because that doesn't mean this is it. Just like the Germans creating bonds out of nothing, definitely hasn't been the standard in the next cycle, okay? Like it definitely changes form. So you have to be adaptive. But the technology is what you need to care about. Like creating IOUs is what has been created and used all along the next cycle. It is broadly used. So don't think ETH is going to be the center of everything. ETH is just like the thing that will create technology. It very likely will be still a leader in the future, in my personal opinion, but still, we're going to have to adapt. Okay, so understand that thing, those two cycles overlapping each other and the two different technologies that there is. I genuinely see people mixing up Bitcoin and Ethereum, and this is one of the reasons why I never do these things. They're two distinct things because they do not play the same role in the big picture of things evolving over time. So Ethereum kind of play in a shorter cycle time frame, but it also means that it will move faster during the next cycle, I believe, as Bitcoin will probably survive in a longer time frame and a longer time scale and have, playing on the longer scale. But that also means that it will probably move slower. Okay, so that's the surface of the iceberg. But there, of course, there are sub-cycles in here, and there's one cycle we need to talk about, which is the speculative cycle, because this one is also showing signs of maturity, but we're still not yet there. So I'll explain everything, okay? This is the big macro cycle. There's the sub-economic cycle that is fueled by either a set of revolution, which is generally, I could dive deeper into this, but we generally find a new source of energy or things like that, and then we create lots of things out of this. And I would say that the recent cycle hasn't been due to energy breakthrough. I mean, we've had nuclear power, but still, I think the latest cycle has definitely been fueled by this monetary technology that allowed creating growth out of nothing, or nothing, not by nothing, but IOUs that I will be able to create money in the future and I will refund you down the line. So the next cycle is going to be different because I think, well, we now have understood that we live in limited resources, that we finally see the huge consequences of over-leveraging the world's capacity and the fact that Mother Earth doesn't have endless amounts of things to offer, and that we might want to allocate them more correctly, otherwise we're just going to all die. So I think this is why we need more of a limited framework of money. With programmable or at least less out-of-control inflations. And therefore, I think that once again, ETH is more like oil. It's the new kind of currency system, I think, that will fuel the next growth cycle, the next economic cycle. But yeah, once again, speculation in here. And the next cycle is the speculative cycle, basically. And this is a sub-cycle that's generally creating the sub-samples of the economic cycles. And we generally see them in three phases, which I'll explain very quickly. Okay, the speculative phase generally tends to cumulative risk-taking. As more and more of a financial world we live in, there has been created financial instruments. I'm definitely talking in here about the derivative cycle that has definitely been subcycling the economic cycle we experienced with debt, because debt has been fueling the complexity of financial instruments, and specifically derivatives, which have been taking a massive amplitude over the next decade. And it's getting even more and more as we speak. So the thing is that this speculative cycle follows a pattern as well. And the pattern is that, first of all, we seek alpha, which means there is a directional trend move all across the board, and people just get exposed to this, to the simple form. It's basically, we got some money, we invest that money, and the price of these assets is rising, so we just extract value out of the price increase because there's no reason to take deeper sides of risk. We just invest and let the investments pull its money out these game. The second set of the cycle is when we dip down in the complexity of derivative risk limitation. That's when we generally kind of have exhausted the gas of the breakout, basically. That's the breakout phase in which we just get exposed to alpha because there's no need to risk limit. We just get exposed to the upside because, well, there's just upside. After the end of a bear cycle, well, basically there's upside potential and people just want to get over this. So in that perspective, when the alpha is burnt down, so this is not a good example still, but when the breakout phase is reaching maturity, when risks start to pile, there is still probably some gains to make, but the risks have increased, so we need to start hedging against this risk. That's where the derivative cycle enters in. Though we generally take the highest set of risk, which is generally out of alpha trading, the traders and market participants starts to beta trade, which means they will look inside correlated assets and they will take a pair of assets, sometimes more, but the simplest form of it is to take a pair. And in that pair, we're just going to look at the one that has the highest beta, which means the one that rises or has a bit more volatility, that rises faster than its colleague. And in that perspective, what we're going to do is that we're going to sell this one, okay? We're going to borrow and sell the cheap one, or not the cheap one, but the one that moves less, that moves slower than the other ones. And we're just going to basically, in a bull cycle, by borrowing this one and selling it to get currency, which is going to buy the other one. So which means we're getting exposure to the beta kind of risk trading, which is basically we're going to support the fastest rising assets by lending on the slower moving ones, which is going to increase, of course, the delta in between these two. So that's the first way to start risk managing. We start to buy the strongest one by borrowing the weakest ones. And that's beta exposure to the market. That, of course, is good because this one starts to reduce the downside potential risk, meaning that if for some reasons both were going down on a consolidation or whatever, well, normally we expect these to move accordingly, meaning that the most bullish one may retrace slightly less than the weakest one. And in that perspective, this arbitrage, while still being in a consolidated market, still brings returns. But of course, it brings less alpha return because, of course, as you have to repay this one, every growth that has been created on this one is subtracted from the benefits that you make when you release that trade and when you sell this one. Okay, you sell this one, but you have to refund the debt of that one, and therefore you have to pay for the delta in the price that has been created in the meantime. Okay, so that reduces the alpha returns, but that also introduce risk limitation over potential consolidations and things like that, but still has to happen in a bull trend, in a background bull trend. So that's when we mature on the bull trend that we start to see beta trading and arbitrage trading. Then comes this third type of risk limitation, which is delta trading. When we basically enter the pullback phase, okay, like would be this, on the pullback phase, we generally see delta risk management, meaning that the arbitrageurs, instead of just gambling on two assets that are rising but at a different pace, now both assets are moving sideways. So they will start gambling on volatility, which means one asset will be more volatile than the other one. Okay, one will move faster to the upside and to the downside. And generally, they will look for assets that do trade correlatedly, which means they still have a positive correlation between the two. They act accordingly at some way. Though in that perspective, what the traders are going to arbitrage is the fact that this one is going to have more volatility. It's going to have higher swings and higher highs and lower lows distance than the other one. And in that perspective, what they're going to do is that on the end of bull cycle, they're going to buy a put, okay, and they're going to buy a call as well to cover for that trade, to get a net exposition of it. But they generally do this. They arbitrage puts and call exposition between two assets, knowing that this one will have bigger price moves. So the derivative expiration on these things means that if you can get on the same amount of time or in the same duration through time, if you can get difference volatility levels, and if you can accordingly predict this, then you're going to get to extract value from the market while still the market is doing nothing. It's basically sideways, but in the sideways action, by the fact that you're arbitraging volatility between two assets, gets you a low risk return. So if you understand of it, okay, when there is huge movement in the price, traders just trail the alpha risk, okay? When we go on kind of slowing pace, generally means that the arbitrageurs are beta trading. When the market is going sideways, kind of the range, generally that's the pullback phase, traders, they tend to go for delta trading, okay? And at the end of it, when we generally go final excess, there is a final set of generally used risk taking among market participants who risk manage, the professional trading, fund managers, things like that. They tend to go for the next set of risk taking, which is gamma trading. Though they know that right now the upside is limited, that it's not going to last forever. So there is a limited time offer to the upside before reversing. Though generally the final set of wave, the final excess, is generally triggered and fueled by gamma arbitrageurs, which generally will do another thing. Though now, instead of gambling over volatility, what they're going to do is that they're going to gamble over time. They're going to gamble that the volatility will remain wide, okay, that there's going to be volatility increase until that date. Though in that perspective, we start gambling over volatility over time. And if you understand that, this one is very, very complicated. Of course, it requires a lot of active management. It's just not like buying a put and buying a call. It's more complex than that. It's arbitraging the delta between them. So this is kind of getting down the road and down the rabbit hole of complexity of derivative products. And you're really going to have to understand that. Alpha is the purest forms to get a return because it basically only requires you to buy the assets. Period. You just buy the asset and you're going to take the alpha returns. When it goes beta, you're going to have to either sell one to buy one, or you're just going to have to buy one and buy puts on the other ones to cover or whatever. But it requires either lending and borrowing systems or arbitraging through puts and calls. But it starts to require either lending systems or derivative markets. When we go delta, this obviously requires absolutely a mandatory use of derivative markets and derivative products, which generally the most well-known arbitrage of delta is buying a put, buying a call, and selling a put, or buying a put as well. Okay, and you do this on a two bracket type of things, which means you gamble on two assets and you arbitrage the volatility between the two. So you end up with a four bracket kind of derivative exposition. You have to buy four derivative products. Okay, when you go gamma arbitraging, what you do is that you're going to play over two sets of expiration, meaning that you're going to buy a put and a call on two assets, but you're going to do this on two different expiration contracts. Okay, so you're going to gamble around the expiration of this one by exposing to the second one. So you got a set of 8 derivative products exposition on the accounting level. So in that perspective, you see that this thing rises up at each and every time by squaring the previous thing. In here you got 2 at best. Here you get to set up to 4 derivative products. In here 8, and there are of course higher sets of risks in here which require as well to square up the risk taking. But in that perspective, if you want to hedge against gamma, you're gonna go theta and vega risk limitation, and these require up to 16. Though you have to understand these things, okay? Because that's gonna require arbitraging both puts and calls on 2 assets on both expirations, and you're gonna have to arbitrage the rate of change between these, which is going to be very, very complicated. That's the vega kind of risk limitation. Of course, no traders go trade vega, but that you have to understand that vega risks is what the broker will do when arbitrageurs are taking gamma risks, because the broker has to be net neutral to the market. And therefore, when the traders who buys and sell those derivative products, the broker has to be neutral, so it has to hedge against the higher set of risk. So what you have to understand is that when traders trade alpha, generally the broker arbitrages itself through beta arbitraging. When the traders are asking for beta returns, the broker has to arbitrage itself against the delta risks. And when the traders are asking for delta returns, then the broker has to hedge against gamma trades. And when the traders ask for gamma risk returns, then in that perspective, the broker has to hedge against vega. And in that perspective, this is real complicated stuff. And we get to make this thing more and more complicated to the point that by just risking a lot of exposition to these derivative contracts, you have to understand that just a tiny mistake will have tremendous impact, because we're squaring the risk and the money implications of these risks. So if one of those products is not well priced in, it will have consequences and rippling consequences the further down the speculative cycle we are. Okay, so this one is a bit trickier to understand, but I just wanted to scratch the surface in here, okay? So you have to think about it right now. Where are we in the speculative cycle? Are we going for delta trading? Are we for gamma or stuff like that? So if you look at the crypto market, and this is where I think there is a very significant difference. between where the stock trading is currently in its cycle and where the crypto is. And that's the reason why I will say over and over again, there's not going to be an endless correlation between the two. It might be a temporary factor, but they are in two absolutely different kinds of contexts. Because crypto might be on the verge for a pullback on a multi-time frame trend. So the difference is, if we restore a bull market, I think that if we're on the verge to start a bull market on the crypto market, we're going to get alpha to get out of it. Because we're just in the infancy of these tradings, and as we have multi-time frame breakout, where there's still going to be a lot of alpha to take out of these markets. Of course, as we're still in a range, we currently have an arbitrage between delta trading, which is getting pretty mature now as the range is crazily mature, and expectation for alpha to show up again. When on the opposite end, when we look at the S&P 500, for example, what we have in here is, at best, we're going to stay there as a kind of a boring bullish range. If what I forecast is right, then this is a wave one extended. We're going to get a first pullback, then a final excess, and a second, which means the next set of trading is a final excess. And the final excess is definitely not alpha. If you got what I said previously, this is not going to be alpha trading. It's going to be gamma exposition, which means the traders will go on short-term bets over expiration times. And why am I pulling this out today? It's because we're on expiration week. And as you can see, there has been hell a lot of volatility within the latest few days. And I think this is just a confirmation of what I've always thought. The thing is that currently the markets are on the verge to differentiate themselves because we see, and at least right now, I have very much clear-sighted tracks that I was on the right call due to the fact that these markets behave differently. The crypto market has been following the stock market, but when both will eventually recover, they will have totally different different sets of maturity in the speculative cycle. So you have to understand these things. The supposedly correlated thing, well, of course, these assets will be correlated to the economic and macro cycles, okay? But the thing is that the speculative cycle has a totally different maturity for these assets. The stock market has made all of its gains already. All it's going to be left for this, if we ever return all-time high, is going to be a gamma trade exposition. This is short-term gambling over expirations. So if you want to trade the stock market, understand it that way. We now have two very important timings to figure out when we speculate on the stock market. It's going to be the central banks meetings, but I think personally that over time we'll get more and more bored of them and getting away from them to, if there is ever a bottom to show up in Wall Street, which I think is very likely going to come sooner rather than later, then if we do this, the bullish cycle that will resume will definitely not be the one that people expect. It's not going to be a to-the-moon stuff or whatever. It's going to be gamma exposition, which means the market will be priced in over those expiration dates, and you really want to duly note all of these in your charts. It's going to be absolutely essential out of that point. So if you want to go up to my website at proindicators.com/dashboard, you will see this 2022 expiration dates. And as you would see, well, added out on May from the 18th to the 20th, basically today, there were different sets of expiration. Okay, so now today we're expiring monthly equity index and cash settle options. So in that perspective, definitely today is going to be hell of a volatile day for stock market because we're finally getting to expire over these things. On Wednesday, there's been a shit ton of volatility as well because we were expiring volatility average products. So note down these things because each and every month, this is going to be where the stock market is going to turn out volatile. So as long as this stupid narrative of the correlation between the two will stand, and it may stand longer than I think, and it has been standing longer than I thought, but as long as this game play, understand that to trade crypto, you also have to assess the timings that comes from the stock market. And the stock market cares only about expiration now because it's going to be all about gamma exposition. If there's ever bulls in this market, this is how they will take on their pieces of exposition to the markets. Okay? So that's one very crucial and important thing to figure out. When it comes to cryptocurrencies, well, like I said, don't put them all in the same box. 99% of cryptocurrencies are bullshit. 95% of them will inevitably go to zero within the next year or so. But that doesn't mean the 5% of them that have value and that will be there probably 10 years from now, though the Bitcoins, the Ethereums, and the like, All of these things must not be put in the same bucket. And if you look at this is why I suggest you look at the crypto 30. In the crypto 30, you don't have the bullshit at the end of the spectrum and stuff like that. So what do you have in here? You have a big fat fucking range, which has never broken to the downside. This is just a fake out in my personal opinion. So if we recover from this, then that means we're back in alpha trade. This is not going to be gamma. This is not a pullback. This is a range in a multi-time frame breakout, okay? We lack of history in here, but remember that the big range we were in right now, this range, okay? If we look at Bitcoin as being the big representative of it, we come out of a fucking weekly to monthly range in here. So we have multi-time frame trend breakouts in here. So this is not a pullback. This is a trend follow of the major monthly trend. So trend follow definitely isn't the same type of risk exposition that we will get on the crypto market, on the stock market. The stock market is going to gamma trade in order to have upside potential exposition in the market, because traders will go safe and easy because they don't know anything about the futures of stocks. Where in crypto, this is a totally different thing. Trend following generally is the moment in which traders starts to get beta exposition. And that's why I've always pleaded for that K-shaped recovery, because that's what makes the most sense out of speculative behavior and maturity in the speculative cycle. As we turn out to trend follow, cryptos will likely see these good old arbitrage in which the good traders will do exactly this. They will sell the crap to buy the good ones. And that's why I've always pleaded for that K-shaped recovery. I've just been so proven wrong due to the shittiest possible correlation narrative that there's been. It may last for a little while, but it's not going to last long. When this thing terminates, you guys will see the difference between the two cycles. And you have to understand that. We have different outcomes in the major cycle, because these things, the cryptocurrencies, will probably be what's going to drive the next economic cycle demand. This is going to be the fuel for the next economic cycle, probably mostly surrounded around Ethereum and its technologies. Okay, though smart contracts and things like that are definitely, I think, going to be the center stage of how money will move around in the next cycle. This is what's going to fuel money distribution over the world, and it's going to be borderless, which is going to change a lot of things. Once again, this is no nation's currency that's going to move around with cryptos, and that's going to change a lot of things. I'm very curious to see how it will be, of course, for the best and the worst. Not everything is just glitter and shines, but that's the thing, okay? That aside, understand that these things are probably the future of the next economic cycle and probably macro cycle for Bitcoin. These are speculative stuff, of course. No one knows anything about the future, but you rather like to have plans and to make them as solid as possible. So here's my plan. In a 40-minute video plus, I really wanted to go down this rabbit hole with you guys to let you know everything that I have in mind, and the reason why all of the plans that I've traded are correlated to a big plans, but I never really had the time to go along the full circle of it. So now I think I've done it. I've explained you all of the major cycles that I'm trading and the fact that I'm trading some assets on different cycles and different time scales. This is the reason why, of course, I think they're going to have different types of trading activity. I don't think Bitcoin is going to surge like crazy like people think it is. It's going to be more and more demanded throughout the next cycle, but currently, well, the demand for this is not yet there because it's not yet a reserve currency. The dominoes are falling one by one, yes, but it's going to take years until Bitcoin goes to millions or whatever people have been spreading shit about. So it's going to be a slow grounding to the upside for Bitcoin, but a safe one. Bitcoin is the safest possible bet, but it's going to be a long run. When on the opposite hand, I think the economic cycle is really urging us to find solutions to the debt problem. We still have years ahead, so don't get me wrong. It's not going to be Ethereum to I don't know how many $1,000s in a couple of months or whatever. It's going to take at least a couple of years in here as well, because looking at where we are currently in the cycle, there is still the gamma risk taking on the stock market to terminate, and there is still, this can take more or less coming from, I think, a few quarters or semesters down to a few years, and I think that we still have time. So there's no urgency. Those who think that we're going to have to rise fast, whatever things, I don't care. I don't think it's really rational enough. So if we're really on the bear market right now for cryptos, I think there are no more downside potential. I think we're already on the worst case scenario, but that doesn't mean we have to rebound V-shape and go all the way to the moon. Because remember that for the cryptos, what's next to come is this arbitrage. If we terminate the bear cycle and if we prepare for the next one, it can take a little while. It can take a few months, so don't hurry. But what you have to understand is that when we start recovering to the mean on the broad crypto market, well, this is where the arbitrageurs will start. The arbitrageurs will sell the shit to buy the good ones. And this can have only one reaction of a price. That means 95% of the market will go down when 5% will be heavily supported by the arbitrageurs. They will push up that trend, not through alpha. Alpha was 2021. Now we're starting to go beta trading on cryptos, where it's gamma trading on stocks, and that cannot support the correlation narrative. They may have cycle correlation, meaning that they move up together and they move down together. Yes, the statistical correlation probably still going to be there, or at least significant enough on a relative number side, but the context in which these markets will evolve will be significantly different, just because the types of risks that are going to be pulled in are definitely different stuffs. Okay? And also the next message, the other message that I spread out into this video and really important for you to understand is that stocks have a limited potential now because they're going to change economic value distribution. So going all in with stocks now is not going to be an easy gamble. There are going to be lots of troubles throughout the next few years. Cryptos will probably fall as well if there is a big crash, but understand that crypto anyway will survive. Because if they are the next support for the economical cycle, well, they're going to be demanded even in the bear market. And you have to understand it. That doesn't mean they will keep rising. They're definitely going to be a consolidation phase. But understand that whoever is trading cryptos and stocks the same way now is making a big mistake. Everyone who's trading stocks now is trading more of a short term, and there's going to be a hell a lot of impact towards each and every month expiration due to the gambles that will be done on the derivative market. On the opposite end, for cryptos, this is just going to be the simple beta trade. So way, way easier than that, which means it requires far less capital. And as there is far less capital required to move them because they have far lower market caps, I think the cryptocurrencies will have hell a lot more returns than the stock market within the next few years. So yeah, we might have a topish market on the stock side, but I think we're far from topish in the crypto. That doesn't mean the 2021 will repeat itself and stuff like that. So no to the moon gambles. Understand that K-shaped trading, by thinking that most of the shit will be sold to buy the good ones, is what you should think about for your portfolio exposition. Okay, that's it guys, more than enough for this one. Hope you've learned quite some valuable stuff. See you on the next one.